This episode was brought to you by Google Cloud, a partner that needs no introduction. What you might not have heard of, though, is that Google offers a Google for Startups cloud program where they give you access to startup experts, technical training, business support, and cover your Google Cloud costs up to $200,000 for 2 years, or even $350,000 if you're an AI startup. Scale your startup faster and smarter with Google Cloud. Head over to goo.gle/Swisspreneur.
We mainly trade base metal concentrates, copper concentrates, nickel, zinc, which might sound like kind of dirty industrial things, but actually that's really what we need for the energy transition.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Sylvan.
James, a very well welcome to the Swisspreneur Show here, recording live at the NOAA conference. Thank you so much for joining us today.
Hey, it's a real pleasure. Great to meet you.
You're the CPTO at Open Mineral, a startup offering metal commodity trade solutions and also enabled by a commercial market intelligence platform. Before we talk about what you do, you actually studied history, then got certified as an accountant and went on to work as a trader. What made you want to get certified and then eventually become a trader?
Well, I was never certified as a trader. I was always an enthusiastic amateur trader.
Okay.
But yeah, studying history, I think everybody should study history. If you look at the most popular profession, actually, of finance directors of S&P 500 companies, it's history. History teaches you about complexity, trend analysis, sorting fact from fiction. So I think everyone should do history. But having graduated with a history degree, I wasn't very good at numbers, and I always wanted to work in business and finance, so I had to go and do my time learning accountancy. So I've never been allowed to practice accountancy, which is probably a good thing, but I did qualify in the exams. But yeah, the draw of the trading floor and kind of specifically commodities markets was always really big for me, so found myself there pretty quickly.
Amazing. And then in 2022, you became CPTO at Open Mineral. Was it a job that you were actively looking for, or more of a call that you got from your network? How did you join the company?
There was a headhunter. I absolutely wasn't looking at the time. I was very focused on what I was doing, but the opportunity came along. I have to say, initially, I was a little bit skeptical. I'd worked across all sorts of different commodities, so from oil and gas and kind of traditional trading markets, futures, options, into metals industry, but most recently in renewables, which felt like the right place to be. So when I got approached by a kind of metals trading concern, I wasn't particularly enthusiastic, but actually I looked at what was being built, and the idea of building a digitally native commodity trading house with like the platform or technology DNA was really attractive. So you never want to be too far away from the action when you're doing things with technology in commodities markets or any markets really. So being close to the trading was always what won me over.
And can you talk a bit more about the specific market gap that Open Mineral was and still is filling in the market basically?
Yeah, so we're a trading house. So we make money from buying and selling commodities. But we do that with a platform. We help in collaborative ways with people who bring material to the market. We mainly trade base metal concentrates, copper concentrates, nickel, zinc, which might sound like kind of dirty industrial things, but actually that's really what we need for the energy transition. So as we're sitting here in Zurich at the NOAA conference, yesterday, I was at COP earlier in the week. Yesterday we agreed, or the COP28 agreed to a very ambitious renewables deployment. And actually in kind of any energy transition scenarios, that's leading to 3 times the amount of critical minerals that need to be brought to market, shipped, traded, transported, risk managed. And those are all things that trading houses do. And so Open Mineral finds itself doing kind of a traditional role in a non-traditional way at a time when the sector really needs capital, focus and professionalism to meet the challenges of the energy transition.
Amazing. And how is your business model? Do you like take a cut of the trades that happen through your platform, or how do you make money?
Yeah, so we started out as a pure platform play. A couple of ex-Glencore, for anybody who doesn't know, Glencore's kind of one of the biggest names in commodities trading. They are located down the lake from here. And I think there's not much in that town apart from, a few trading companies and a Ferrari dealership, which tells you a little bit about how well they do. So it's a very lucrative sector, but it's kind of a traditional sector. So often it's very relationship driven, not necessarily in a dodgy way, but these are very risky supply chains. Geographically, it's a long span from the source to the end user, spanning many different geographies, jurisdictions, complexity. So people naturally learn to bridge these problems and risks with trust and relationships. But relationships don't necessarily optimize for cost. Information and data sometimes make relationships a little bit redundant, and you find potentially marketing material over a platform globally. Actually, if your job is to market the material and to use your Rolodex, you're kind of voting for your own kind of redundancy in some ways by adopting a platform. So there's always been a bit of institutional resistance to going fully online, and the kind of eBay for commodities markets hasn't really ever tipped over into being. So that was kind of the origin story. And what we found over the years is actually stepping into those transactions and taking principal risk, but doing it with data and marketing the material with the platform was quite lucrative. So having come out of a traditional kind of buy low, sell high trading model, and then kind of use data and platform to try and disintermediate, actually there's a hybrid in the middle, and that's kind of what we call the digitally native or digitally driven trading house. So the majority of our revenue comes from finding material. We call that origination. So working with producers or miners, in our case generally, helping bring that material to market. So working to understand the complexity of the specification. So you don't dig up pure copper, you dig up concentrate, which has lots of different chemical properties that vary. And understanding the complexity of that material and potentially marketing it alongside other materials and kind of creating blends that together are worth more than the sum of their parts. That's something that we're very digitally driven in how we do. So that knowledge combined with our technology, combined with our kind of database and 85 professionals who do this and have done this for a living, leads to this kind of hybrid approach. So we originate the material and we bring it to market. We ship it, we understand the insurance risks, the transport, the customs, and we do that by truck, rail, vessel, all over the world. So I think we've got live at the moment, we've got, I think, 95 trades in 40 different jurisdictions.
Wow.
Just a high degree of complexity to manage, and that's where we make our money.
Fantastic. And you talk about risk. If I understood you correctly, you also take some significant risk on your books, so to say. Is that right?
People think that I think there's a misconception. People think that trading and commodities trading is about taking big bets, having really big, gutsy calls and putting a lot of capital at risk. Actually, I mean, there's a phrase, there are many old traders and many bold traders. There are not many old, bold traders. Somebody told me that on my first day on the trading floor. I think that's true. What you're looking to do is understand when risk is mispriced. So if a material is being priced too low or too high, or the different geographical arbitrage, we call it, the price from a different place, that kind of adds up, we look to lock that in. So we don't ever take particularly exposure. We don't take a view. Like I can't tell you what the price of oil or copper will be tomorrow. I could guess, you could guess too. That's not our business model. There are people who do that, but most physical traders, and particularly kind of digitally enabled ones like us, we try and minimize risk and get paid for the kind of the fee of bringing material to the market.
Fantastic. It makes a lot of sense. And you have also raised money yourself, 40 million so far. You're also currently fundraising. Why was getting investors on board the right strategy for you?
Yeah, I can't take the credit. I think our last round closed just before I joined. Our Series C was closed. I think that was $33 million. Mubadala, the sovereign wealth fund from Abu Dhabi, led that round. I mean, we operate in an extremely capital intensive industry. Like the minimum cargoes that we might look at will be, we'll buy you a house, like a nice house in Switzerland. It's a very expensive capital intensive industry, and it works on the size of your balance sheet as a company, and then your ability to work with trade finance banks and financiers to leverage that. So we have an equity capital stake on our balance sheet, and we also have trade finance relationships with banks. So we have a couple of $100 million of trade finance lines that we're looking to grow. So for us, even though we've turned over quite a lot of money and we're a relatively large business from kind of like a startup platform perspective, from a commodities market perspective, we're tiny. So for us, we need investors to grow. But beyond that, I would like to say and kind of give a shout out to our investors. I think they've brought a lot of professionalism, a lot of ecosystem development. I've just come from Abu Dhabi, where I've been for the last few months. We've got a big office there. It's really interesting to see what's happening in the Gulf in general for some of these industries. And there's a lot of, that's kind of clearly where the music is for investment and kind of growth of these things. So yeah, so we had to invest and size up as we kind of started to take a bit more proprietary risk. And we've been very happy, not just with the balance sheet contribution, but with the overall effects from having a really kind of marquee set of investors on our cap table.
You're active in a global business. However, your headquarter is here in Switzerland, in Zug.
Of course.
Why was Switzerland the right choice for you?
Well, look, I mean, the roots of trading, commodities trading, and in this part of the world are long and storied. I think the talent pool is great. A lot of our colleagues come from the big names and kind of grew up in the big trading houses, all of whom have left to come and do something a bit different, by the way. So they've left very well-paid, comfortable jobs with market leaders to come and join the industry insurgent. So that was a good vote of confidence. But I think the ability to access talent is important. It's a nice place to live. There's a lot of infrastructure. There's a good banking sector, support sector, logistics sector. So Switzerland's clearly a global commodities hub for a reason, and it makes perfect sense for our business to be headquartered there.
On the other hand, I'm sure we also have things to improve in Switzerland. From your perspective as an entrepreneur in Switzerland, what can we do better?
Maybe it's an unfair comparison, but there's a direct comparison between growing our team in our Abu Dhabi office and our Swiss office. We found the government support, financial, but more kind of practical, kind of door opening, office space, introductions into the financial ecosystem, kind of nurturing events, networking. We found the degree of organization and determination to be the right investment climate and kind of venue has been extremely, surprisingly good in Abu Dhabi. And in fact, a couple of the speakers here at the conference have referred to that in their remarks today. There seems to be more that Europe could do to get a bit more organized about getting venture capital, particularly, and kind of the business climate right for high growth startups.
Is that also on a political level to make it more attractive or to set more attractive incentives to do so?
Yeah, look, I mean, there's no secret that there are parts of the world that will pay you to come and hire people there. So I run a team of software developers, and we've been able to relocate people to the UAE. I think that used to be a hardship posting maybe 15 years ago. It is not now. It is a nice place to live, extremely safe, extremely comfortable, zero tax. Of course. I'll just say that again, zero personal tax. So it's a very attractive place, and you see fund managers. Ray Dalio just moved there. A couple of billionaires are relocating there. And it's not just to be offshore. I think it's to be in a growth place that's committed to business, is pro-business. So yes, I don't see enough nurturing, recognition and kind of endorsement of the growth sector, either from a fintech lens or from a kind of traditional commodity trade lens. And I think there is a real danger that some of the shine might come off of Switzerland. And, it's not just that these guys have more money in their sovereign wealth funds, it's that they're being very organized, very pro-business, and very welcoming. And that's a competitive threat, I think, to Swiss position as a natural hub for this industry.
Yeah, I feel we can get too comfortable by where we are today and then sort of lose track on the homework we should be doing to stay in that position.
Correct.
We often also see policies or even not sanctions, but like clear policies that you need to enforce on the sustainability part. And that is also sometimes the challenging aspect in the commodities trading aspect, right? So How do you actually handle sustainability with your business?
Yeah, we think really carefully about it. Base metals is by definition sometimes a very dirty extraction business. And particularly arsenic poisoning in water supplies, that's really bad. I mean, if you were to look, there are some headlines around carbon, obviously, around child labour potentially in mining practices. There's a lot of coverage there. There's not very much coverage of the global arsenic problems. 100,000 people a year die from arsenic poisoning related to the transport of kind of extraction of base metals.
Wow.
So for us, we're very keen to partner with technology providers that can remove arsenic pollution from the refining and extraction processes. We've been very keen to do that. We're very keen to make sure we work with reputable upstream providers that offer the strictest ESG guidance. And we follow kind of best practice on that. There aren't global standards, and it's difficult. So it's definitely top of mind for us. We are in a dirty business by definition, even though the stuff we're doing is to make the world electrified. So we try and pursue really strong governance, particularly in our partners.
But I can imagine that is a big challenge to go this extra mile, as you just described.
Yeah, it's difficult. Nobody pays you to self-sanction.
Exactly.
Or to kind of hold yourself to the higher standard. I mean, fortunately, we're very committed to it anyway, and we see that there is an indefensible position within an ecosystem from failing to do that. So although we wouldn't break a law potentially if we were to do something that was, with a counterparty that would be found to be doing something really bad, to be very simplistic about it, that would have a knock-on effect for us with our banking relationships, with our hiring abilities. So it's really important, purely for selfish reasons, for us to be as compliant as possible with best practices around governance.
I like how that goes hand in hand. It's the long-term game that you're playing, basically.
Yeah, absolutely.
And talking about relationships, you also have recently partnered up with Tradeflow Capital Management, and together you're connecting the trade finance investors and also banks with digitally de-risked transactions of global mineral flows. So first of all, what's the major benefit of this partnership?
Right. So we were talking about kind of capital, and you asked why we raise money. So access to capital and particularly trade finance, that means making sure that the gap between somebody selling material, say in South America, and buying it and it being delivered 40, 50, 60 days later in mainland China, for example, that gap while the vessel's on the water, that's trade finance. And that's the same whether you're putting, dishwashers in containers and shipping them from Korea to Germany or whatever. It's the same need. And that globally has been assessed by the Asian Development Bank as a $3.4 trillion gap. So banks traditionally were the kind of key providers of trade finance, and they've taken a step back over time, increasingly reducing their footprint, offering this important piece of liquidity to global trade. And that's also felt in our sector in commodities markets. And that's a function of some of the stuff we were just talking about, ESG and compliance and the cost of compliance. It could cost a bank $50,000 to KYC us as a counterparty. So just before they've even done any business with us, they've incurred a $50,000 cost. And understandably, they are looking exactly at kind of where they deploy their balance sheets, particularly in a high interest rate environment. And they're deploying it against the largest counterparties that they have and the sort of perceived lowest risk and the kind of scale of the relationships, which leaves a huge amount of the global trading complex, not just commodities, but everything, unbanked. So that's that $3.4 trillion gap. Trillion. Not very often you hear the $1 trillion. So, and that's true for us. So we've got more material, or we've got access to more material around the world than we can finance to ship. And so one of the biggest growth levers that we can pull is trade finance. Now, we've really liked seeing what the guys at Tradeflow have been doing in Singapore and around the world. They've taken a very different approach. So whereas a bank will look to lend money, they actually take ownership of the cargo of material.
Wow.
They buy it at the beginning and they sell it. It's repo financing, it's called. Nothing new about that, but what they've been doing very successfully is digitizing the supply chain. So understanding mentioned KYC. It doesn't cost them $50,000 to onboard a client, and they probably do it to a higher degree of accuracy and compliance than a bank. And they've done that through meticulously and very expensively building software as a service, I guess, for their own in-house processes. So they were able to do, we were very impressed, they were able to do 3,000 cargoes over the last 6 or 7 years. And they've returned extremely healthy returns to their investors who've given them money to facilitate this trade in their non-lending trade finance model. So they've got real proof of scale in a digital product and a different financial model. This is perfect, we think, for commodities markets as well in general. So they've looked across agriculture, but specifically for metals markets, so our sector. And so we've got some digital platform components that can help with complexity of our specific space. So we've created a joint venture with them to put some of our intellectual property in with some of theirs and license it exclusively for the energy transition metals. So we are getting a lot of inbound traffic from investors who want to deposit funds and get a fixed income return from providing liquidity to make sure that we've got the critical minerals needed for the energy transition. So this is one of those really rare opportunities that I've never had in my career. Maybe you only get one, hopefully more, where you really come across a kind of a merger or a combination of two businesses that really adds up to more than the sum of its parts at just the right time. So we're super excited to have done that deal.
I would love to talk about the timing, because timing is a key factor of the business success in the end. Mm-hmm. You talked about, we will need much more of the energy transition minerals. Mm-hmm. So despite that, why is the timing ideal right now?
Well, I mentioned banks stepping back.
Yep.
Interest rate cycles are high. Cost of finance is high. So that supply-demand gap is getting bigger. That's the supply of capital and the demand for capital. And that's all being driven by the energy transition. But why now? I think there's a sweet spot for us. So we are sizing up our book. So we're hoping to double our revenues next year. To do that, we need access to trade finance. And for Tradeflow, the timing was right for them. They've done very well growing across all of the sectors that they look at, but they wanted to step into metals. So I guess a bit of luck.
A win-win combination.
That's right.
You also said that you formed a joint venture. How does that work? Who calls the shots in the end? How do you govern the new joint venture together?
Yeah, look, it's really important. We mentioned compliance. We want to make sure that we're not just serving Open Minerals Trade Book, although we'll be the first customer. And if we're the only customer, that's fine. But we think there are other people out there that will want to use the service, as they do with Tradeflow today. So it's very important that we have fully segregated data management. So the new entity won't be, we won't be able to call the shots in it. We'll be a customer as Open Mineral. Mm-hmm. We'll be an arm's length investor, but a minority investor actually, I think. And we'll make sure that it's a really good service for us, but that we're not in any way able to kind of access the trade data of others. So it's really important to be fully separated. Mm-hmm. Setting up a joint venture is easy. Kind of governing it effectively is difficult. But we've got a really good working relationship. We'll set up the governance to make sure we don't have any deadlock, and we've got a very clear path ahead, and we get on very well, and we just want to get on with building that business alongside our other core business.
Fantastic. You have a very clear plan. And
we do.
Talking about the plan, what are your plans for the future? Do you also plan to eventually either get acquired or do an IPO yourself with Open Mineral? What are your plans there?
Yeah, so digital platforms with recurring revenue are very attractive on exit and have good IPO journeys. Commodities trading houses, there's been one major IPO, but that was asset backed. So they were able to do it because they had some physical assets. But generally, if you've got a traditional legacy trading house, it's got a concentration of intellectual property within some of its employees. So it's difficult to see that, it's a bit like selling a law firm, what happens if the lawyers retire or go and work for someone else. So we've been building up a set of IP that we think codifies a lot of the operational advantage. So we're less kind of trader-centric, we're more data-centric as a core business. Mm-hmm. But part of why we're doing this JV as well with Tradeflow is because we've got IP that can scale using technology, and we don't want to just be constrained to what one trading house can do. So I can well imagine an IPO journey for the newly formed critical minerals trade flow platform. And that's something that we're very interested in doing, maybe here in Switzerland, maybe in Abu Dhabi, who knows. So that's a kind of 3 to 5 year journey there. Because it's subscription revenue, it's recurring, it's a service, it's data driven, there's network effects, it's a genuine platform business. The core business, I think we're very attractive to major sovereign wealth players who are looking to consolidate the flows of raw materials needed for their ambitions. If you think about what, I don't know, Japan went through in the 70s, Singapore in the 80s and 90s, there's state level kind of benefits to coordinating your ability to trade commodities. So, we're very close to some of the Gulf sovereign wealth funds, including our current investor. So that's maybe a potential avenue for sizing up or exiting or kind of going down. But for now, we've got plenty to do day to day in growing our core business and shifting tons of what the world needs around the world.
Absolutely. And James, to wrap up the episode today, I also have some rapid fire questions for you. I give you a short question or different options to choose from. You have to answer in one sentence.
Okay.
Humans or robots?
Humans with robots.
I like that. Forgiveness or permission?
Forgiveness.
Centralization or decentralization?
I want to say decentralization, but I just don't think it's there. I think some sort of combination. Decentralization makes sense where it makes sense as a product, not as a philosophy. Sometimes you need to centralize. You need central standards. You need central governance sometimes. It's inevitable.
Where do you need centralization and where not?
Well, that's a huge topic. But for example, safety standards.
Yeah.
I don't want to decentralize those. I want to put some trust in a non-political body to set the right standards around how we operate.
I like that. Great example. Wealth or happiness?
What's the phrase? Money can't buy you happiness, but I'd rather do my crying in a Porsche. That's the commodity trader answer. Happiness, they're not the same thing, but societal wealth is the route to happiness.
Absolutely. And the last one, Zug, Abu Dhabi or London?
Right. Wow, come on. London for the food and the nightlife, Abu Dhabi for the weather and the Grand Prix, and Zug for the talent pool and the cozy atmosphere this time of year.
That's a very Swiss answer, very neutral with the highlights of all of them. James, thank you so much for coming on the show. All the best and lots of success on the future journey.
Pleasure. Thanks, Sylvain. Good conversation.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.